Okay, welcome back. And today we are going to do monetary policy. But before we start with monetary policy, there is a very important thing that you need to understand, and that is the concept of the bond. Because in this chapter, we are going to study monetary policy and the money market in connection with the bond market. So that's an important thing. Obviously, before we go to that, we are going to cover monetary policy in detail. But before we go to that, I want you to understand what bond is. So, bond is nothing but a certificate, and when you have money, extra money, you go and buy a bond, and it means that the person who has sold you the bond, the seller of the bond, is going to take the money for a fixed period of time, and at the end of that period of time he is going to return the money with interest. So in reality, a bond is a certificate of promise. It's a promise that once you, the bondholder, if I purchase the bond, then I am going to receive some payment at the end of a fixed period, and that payment is going to be with interest. So please keep in mind that the person who issues the bond, the person who sells the bond, has the authority to borrow money. Now, this is a very common way of borrowing money, especially by the federal government. But please do keep in mind that federal government is not the only authority that issues bonds. Bonds can be issued by state governments. Bonds can be issued by, in certain cases, by local governments. Bonds can be issued by companies, and there are various kinds of bonds that are issued by the companies. Some are um, very high rated bonds, which means that the person who has issued the bond and borrowed the money is very secure. He is not going to default on his promise to pay, the promise to return. So these are usually called the A rated bonds. And then there are other bonds, which are issued by borrowers who are not very creditworthy. So their promise to pay is not considered a very strong promise, a very good promise. They issue bonds like junk bonds. So junk bonds may be issued by people who are not very creditworthy, and that's why when they borrow money by selling bonds, they are going to offer a very high rate of interest. Why? Because interest is not just the cost of borrowing; it is also a compensation for the risk that the lender takes by giving money to the person selling the bond. So please keep this in mind. Another thing is the bond is not permanent finance. We are The bond is an instrument of finance, yes, but we are not studying finance here. We are only studying the bond market in relation to the money supply. So please do keep in mind there's going to be no valuation of bonds in this chapter, but the connection between the bond market and the money market is strong. Therefore, we need to understand the bond market a little bit. Bonds are issued, the person who is borrowing by selling bonds usually borrows for the long term. He is borrowing for a long period of time. What do you mean by long term? Now, yes, in economics, we don't use the word term, we usually use the word long run. But because this chapter is borrowed from finance and accounting, so we are going to borrow that term, long term. So, long term here simply means more than 3 years, uh, 5 years. There can be 10-year bonds. If there are mortgage bonds, then those bonds can be up to 30 years, which means that you borrowed money by selling bond for a period of 30 years, 10 years, 7 years, 5 years. So bonds are long term, usually long term um, instruments that are used to raise money. And when you sell the bond, that's when you raise the money. But like bond, there are also short term instruments. They work exactly like bonds. You sell them and you raise money. So when the government needs money, what does it do? It sells bonds. If it needs money for 10 years, 5 years, 7 years, it sells bonds. Likewise, if the government uh, needs money for the short run, it needs money for like 3 months, 6 months. Then what happens? It's going to sell what are called treasury bills. Bills are usually for the short term. Bonds are usually for the long term. But here we will use the word bill, and but the word bill will not feature in this chapter. This is something that I've just told you. The bond is the word that is going to feature in this chapter, because there is a special market where bonds are bought and sold, and that market is called the bond market. So, if that is clear, then let's have a look at a bond. This is not a dollar bill. This is not a dollar note. This is a U.S. Treasury bond issued by the United States government in order to borrow money. And This bond has a face value. Okay, there's always a face value to a bond. Um, What is the face value of this bond? Dollar 500. It's written there, $500. That's the first thing. The second thing that you need to keep in mind is that the bond will be purchased back by the government after a fixed period of time. All right. So after the period of time after which the bond is purchased back, that period is called the maturity period. So the bond will mature, and the government is going to return the money by buying back the bond. So that's the second thing. The first thing is the face value. The second thing is the number of years after which this bond will be bought back, and that's when the government is going to return the value. Let's say the bond is going to mature after 10 years. So after each year, the government is going to pay a certain amount of interest. That amount of interest, oh yes, look at this bond. This bond is going to mature in 1972. This is an old bond, so please do keep in mind. So this was issued in 1967. It will mature in 1972, which means this is a 5-year bond. Okay, so and then let's look at there's another thing. For on this $500, the government of the United States pledges to pay a return of 2.5% each year. So this 2.5%, which the government uh, uh, promised, it was probably the interest rate in 1967 when this bond was issued. This interest rate, or this payment rate which is printed on this bond, is called the coupon rate. Please do distinguish between the coupon rate and the interest rate. The interest rate is the rate of return which is prevalent in the market. It is not printed on the on the bond. So when it was issued in 1967, it had a return of 2.5%, but the interest rate in 1968 must have been different, higher than 2.5% or less. 1970 must be different. 1971 must be different. But the return which is printed on this bond will remain the same. The coupon does not change. The interest is in the market, so it will keep on changing. So these are a few things that you need to keep in mind about. The other thing that you need to keep in mind is that these bonds will now, this is your asset. The person who has bought this bond, for him, it's an asset. It is an it is a promise to pay by the government. It has value. So these bonds can then be sold, like all assets can be sold. Your car can be sold, your house can be sold. So this is an asset. It has value. This will be sold. Now please do keep in mind there is a relationship between the prevailing interest rate in the market, the coupon rate, and the value of this bond at which it will be sold. The value which is printed on this bond is 500. Now supposing that the interest rate in the market rises to 4%. Okay, which means if I were to invest this $500, I have $500, and if I invested it in a bank account, for example, I'll get 4%. But this bond is giving me only 2.5%. So I'll be a fool to buy this bond for $500. Why? Because why will I choose to earn 2.5% when the market is giving me 4%? So in order to sell the bond now, you will have to reduce the value of this bond. Okay, so keep this in mind. This bond, when it is sold, when it's bought from the government, it will be bought at $500. But if it is resold to somebody else in 1968, for example, 1970, for example, the value of this bond will be determined by the prevailing interest rate in the market. If the interest rate is higher than 2.5%, the value of this bond will fall. Why? Because it is offering less than the prevailing interest rate. It's offering less than 4%. It's offering 2.5% only. So the value of the bond will go down. And if this bond, if the market interest rates fall and the bond is offering 2.5%, if and the market interest rate is 2% or 1.5%, then the value of this bond will rise above the face value. It will go above $500. Okay, there's another important thing that you need to keep in mind, which is very important in relation to the bond. That is the return on the bond. So, return on the bond is completely different from the interest rate or the market price or the coupon rate taken individually. It's different. The return on the bond is the coupon rate. The coupon rate is not the return, nor is the market price of the bond the rate of return. It's very important to keep that in mind. The yield on the bond or the return on the bond is, by the way, yield is a technical term used for return by finance analysts. So we will just use the word return. We are doing economics. So, but keep in mind, yield and return is the same thing. So how will you calculate the return on the bond? The coupon rate, which is given here, which is 6.25, divided by the current market value of the bond. So the current market value, let's say interest rates are higher, it's higher than 2.5%. So the current market value is going to be less than 500. And keep this in mind. Let's say, let's look at this example. If the coupon rate, let's say for another bond, is $20 and its market value is 550, then the return on the bond is 3.6%. 20 divided by 550. On the other hand, if the interest rates rise and the return and the value of the bond falls from 550, it goes down to 550, it goes down to 450. Then you divide 20 by 450, the yield on the bond, the value of the bond, the market value of the bond falls. But when the market value of the bond falls, the return on the bond rises. 20 is now a greater percentage of 450 than it was of 550. So when the value of, this is a very important rule to remember, don't forget it, because this will come in very handy when we are doing the relationship between the money market and the bond market. So 20 is a greater percentage of 450. When the value of the bond falls, the return on the bond rises. Okay, and this is a picture of a certificate issued by the government of Pakistan. Please remember that in the third world countries like ours, these markets are not very well developed. But in order to understand economics in the developed markets, very important to understand the bond market. Okay, so I hope that this is understood. Look at this example once more, and my advice is do this example yourself to understand the bond market. In the next video, we are going to do monetary policy, and in the video after that, the relationship between money market and the bond market. Okay, thank you very much indeed.